We're going to talk about the bond market and the dollar in this video, but just a follow-up from the last video, some new information came out. In the last 4 weeks, a record $58 billion has flown into stocks. Now, some are calling this FOMO, fear of missing out. Others are calling it a melt-up or blow-off top. And even the Wall Street Journal recognized the dynamic of fear and greed. But there really isn't any fear. It's all greed. For that amount of money to come into the market at such extended valuations really shows how rational investors are. They're not taking valuations into consideration at all when buying. They just see the market going up and up, and they want to be a part of it. One thing I wanted to look at was an article looking at how the US dollar has traded in the performance of bonds. I'm beginning to think that the model is not broken, but needs to be adjusted for the fact that QE is now undertaken by various central banks simultaneously, rather than just by Japan. The big increase in QE from the ECB and the BOJ that we saw in 2016 has seen capital move from Japan and Europe into the US. This has meant that even as the US has raised rates, credit conditions have remained very favorable. This, combined with the recovery in China, has created an extremely favorable market for all assets in 2017. Of course, this is nothing new. We know that global financial markets are interlinked, and the policies and decisions by one central bank generally reverberate through the entire system. Like we talked about last week, as the US exited quantitative easing in 2014, the ECB picked up where they left off. And it doesn't really matter who's printing the money. As long as someone is printing the money, it'll find its way into markets. His worst case scenario view is profound weakness in the dollar, which would cause the Fed to increase rates faster than expected. Taking a look at potential catalysts for a crash in the bond market, we see 3 possibilities here. The first is unanticipated inflation drivers catching markets unaware. This is very plausible as inflation has been ticking up and investors haven't seemed to be taking notice. Also, inflation could be rising faster than expected due to price appreciation in commodities across the board. So here we see Power Shares commodity ETF over a 2-year period, low at 11.70, high at 17. But even if we just look at the last several months since June, it's up more than 20%, which will trickle through into inflation numbers. The second is overly active central bank making policy mistakes. They give the example of the taper tantrum, which happened in 2013 as the then Fed chair, Ben Bernanke, announced the US would be exiting their quantitative easing program and stopped buying bonds. The market reacted very negatively and started to pull their money out of bonds, causing interest rates to spike sharply. This could happen sooner than expected if the falling dollar does start to accelerate, causing the Fed to have to change up their policy or increase the rate of rate hikes. The third reason doesn't seem to be a catalyst, but more of a snowball reaction that would occur if the bond market did crash. The third is a contagion, as rising rates trigger weakness in stock markets and a raging unstoppable tide of zombie defaults, leading to a blowout among high-yield names, setting off wider spreads right the way up the credit ladder. Basically, this just means companies that don't make any money, unprofitable tech companies that rely heavily on debt to finance operations. A good example is Tesla, who's never made a dollar, burns an incredible amount of cash. In Q3 last year, they spent $63 million a day and never made any money. But because of the credit environment and money being so cheap, they're able to easily finance operations at a relatively low cost. Like the Tesla bonds that came out over the summer, they were bought up immediately and should clearly be terrible investments given that they have no positive cash flows, and even their largest asset, the Gigafactory, isn't included as collateral if the bonds default. Yet investors bought up every single one as the appetite for bonds is so high. Let's take a look at where bonds are today. Here we have a 2-year chart. We see the sharp sell-off after the election and a retest creating new level of support, which was just recently broken. The rally into the September rate hike meeting, which we can see a small blow off top here, and it's been selling off ever since. Just last week, we broke this low, created back in last March at 122.200. We saw traders react to this level here, bouncing off and entering some congestion. However, on Wednesday we broke through with follow through, and today have just broken through another level of support, a much more significant one, created all the way back in 2013. This is the 122.70 level, and we are currently at 122.40. It's hard to tell where the next level of support is, as this has been pretty choppy and volatile after the financial crisis. However, the momentum downward seems to be accelerating as it breaks through support levels. This is definitely a chart to keep your eye on, as the 10-year has reached 2.64% and is likely heading higher to 3%. Next, we'll look at the dollar. All right, we'll look at a 2-year first, just get an idea. So here's the election. We rallied sharply after the election, along with stocks. It was all part of the pro-business, pro-America agenda. It wasn't really rising off of any fundamentals, but really speculation off of a stronger America in general. However, this was really just a head fake, as we sold off just at the beginning of the year. What's interesting is the top here was called by The Economist, not on purpose, but as they've done many times in the past. There's an investing theory where anytime the mainstream media gets a hold of a trend, it usually marks the end of it. And this particular article came out the week of December 9th, just before the dollar put in a top. For much of the year, it couldn't get out of its own way, falling into the September meeting that we talked about in bonds, except the inverse here, where the rate hike actually helped the dollar, where it managed to rally back up to 95, where it put in a double top right at 95.20, and has sold off since, putting in a series of lower highs and lower lows, breaking this upward trend line here. We see it tried to find support around the 91.75 level, but failed. Sold off, tried to test 91, but broke through intraday. Here we see it forming congestion between around 90.10 and 91. Upward resistance is established here, right at the 90 level. Let's get that right. And support right around 90. So here we see a tight range between 90 and 91. However, if we look at a longer term, we can see this 90 level is more psychological than actual support. There's some slight congestion in here during the huge rally in the dollar as the US exited QE. However, this is not very strong support, and will likely break here. If it does, it looks to be going a whole lot farther. It might find support around the 88 level, where there's a lot of congestion. If the dollar really begins to fall and take out the entire gain we've seen over the past few years, this is where we would see panic out of the Federal Reserve, and which would likely influence the stock market in a negative way. So here we see two potential market movers near critical points, which we'll have to keep an eye on and see how they influence the market. Next, we'll take a look at crude oil quickly. Crude's been absolutely running. After a pretty flat year, making up almost all of its gains in the last 2 months, we see at the beginning of the year couldn't get out of its own way, kept falling as production numbers were rising and rig counts rising. However, during the summer, it took a turn and started to rally, putting in higher highs, higher lows, and eventually breaking up through key resistance levels, the 50 and eventually the 55, as well as this long-term downsloping resistance line here. We see the retest at 55 as a critical point. After retesting, rallied, came down slightly, didn't even retest 55 again, and was off to the races. Now we're at the next critical point at 62.50, created back in 2015. Broke up through easily and is currently retesting. We saw it hit today, almost right at 62.50. Had a low of 62.78. If we see upward movement from here and a break of these highs at 64.89, we're likely to see higher oil prices in the future. It looks like it could be a quick shot to 70 if we can get there, and really won't face heavy resistance until the 80 level. Next, we'll take a look at gold. So gold for much of last year was choppy but ended up being positive. We rallied sharply into the September rate hike meeting, which we saw influence bonds and the dollar, cause gold to sell off, trade sideways, eventually broke this trend line, but eventually found support and rallied sharply. Gold seems to be at a critical point where it will either break down or up. Here we see a long-term wedge created from the 2011 highs. If we look at this wedge, it looks like gold has already broken out and retested. From that perspective, it's already broken out of that wedge. But if we look at a shorter term wedge from here to here, actually I'll change those colors so it's easier to see. If we look at this wedge now, it seems to be testing the upward bound with upward momentum. So the likelihood of a breakout here is higher than it falling. If it does fall, we'll look for it to rally before it hits the upward sloping trend line. However, breakouts usually tend to occur at 2/3 of the apex of the triangle, or the wedge, which looks to be about where it is today. If you're planning on trading this, you can anticipate the move and get in before it breaks out, or take the more conservative approach and wait for confirmation before entering your position. Lastly, I just wanted to follow up with Bitcoin to see where it is after crashing last week. Here we see the fall that was in the last video that we were talking about. It's rallied since then, now at 11,250. But we do see a trading range established here between 11,000 and 12,000. I can't draw lines on this, but you can see it trading within these bounds. It doesn't look good here if we take a look at the 1 year. Long-term momentum is still up, but Bitcoin's all about the now. So we're still in a downward trend. And if we look here, it looks to be forming a bear flag where we see a sharp fall down and a slow recovery into congestion, where we're likely to see lower prices to come.